All right, folks, welcome back. We're going to be looking at the Nasdaq 100 futures March delivery contract for 2023. This is our daily chart. And let's go right into the volume imbalance right in here. And this is a level I had in mind for Wednesday's trading. I was expecting it to trade up into that. Now it's the body close to body opening with this single pass through here. And what makes this a volume imbalance? Well, if you look at the low of this candle here, let me move this out of the way. This candle's low, that wick, and this candle's high, that wick, and this candle's wick. All of this price action in here was closed in simply with the wicks, no bodies. Okay, so because of that, my eye was drawn to that, and the algorithm would like to refer to those types of price points. All right, so with this in mind, I was anticipating a likely run up into this volume imbalance. So when we see this shaded area here, that color, dropping down the lower time frames, which we'll do now on the 60-minute, my students should be only focusing on Monday, Tuesday, and Wednesday up to New York session for trading on non-farm payroll weeks. So non-farm payroll is the week, typically the first week of every month. And on that Friday, employment numbers come out. On Thursday and Friday of that week, it tends to be a little choppy, a little less likely to be as precise as one would expect or hope for. And the same thing occurs usually after New York session on Wednesday. So any position overnight from Tuesday into Wednesday, London Open, that would be favorable, but we usually try to square positions. But I forced myself into the environment today just to show you how the elements that I look for that are repeating in phenomenon, that have precision, signatures that give me high degree of accuracy and such, they don't pan out as precise as other days or weeks in the month. So you'll see some of those elements creep into this analysis in the trade review. So I've already posted a real quick vignette prior to this video, and I shared it on Twitter earlier as well. But this is going to be more or less me breaking it down. So that way, if you want to know how to do this, it's not a enticement for you to trade on non-farm payroll weeks, Wednesday, Thursday, and Friday. It's to just draw your attention to the fact that this is why I teach my students this. I mean, look at the price action here. I mean, just look at it. We had FOMC today at 2 o'clock. So all this back and forth movement, it never even touched the volume imbalance. But that's fine. It doesn't need to do that to be profitable. This is the level I'm looking for. So you could make the argument that, hey, look, you have this here, it traded up into that. Yeah, sure, that's fine. But I'm looking for a higher time frame PD array to reach to. So while it did take out relative equal highs here, as we'll see in the lower time frames, and you probably already watched in that little short video, it's not enough for me to feel satisfied in that. I'm always in a pursuit of precision. I'm always looking for elements of algorithmic price delivery that will be a step beyond the average retail analysis concepts. So we're going to look at this low here on the 3rd, and we're going to dive into this here, that fractal, that low. Inside this price action is going to give me insight about this low here, why I trusted going long there, and a run for the relative equal highs, and potentially run up into this area here. We're going to take a deep dive into this low here and focus on these relative equal highs and that volume imbalance, so that we have a framework here on the hourly chart. So let's drop down to 15. Okay, so you can see that low here and these relative equal highs. And then we have that run here that fell short. And we're going to, again, focus on this area in here. Already you can start to see there is a imbalance there. But we're going to fine tune that little area into the 5-minute chart. Okay, so relative equal highs. So this low here is January 4th, Wednesday, 2023 on a 5-minute chart. If you scrub back over to the 3rd, Tuesday, January 2nd, January 3rd rather, you'll see that we have this down close candle and we have this movement here in price. Okay, so that's a buy side imbalance, sell side inefficiency. But this this high of this candle here, this down close candle, prior to this move up, that's what I'm anchoring on for the price level of 10864.75. Okay, so if we look at that in relationship to the low, it pretty much nails that right there. That's not enough. That's where I was looking and had my initial interest in it. Now we're going to drop down to a 1-minute chart. We're going to go back inside that old low on the 3rd. We're scrubbing back, and you're going to see there is that buy side imbalance, sell side inefficiency, that single candle right here. I'll move it out of the way so you can see. And that down close candle, which was on the 5-minute chart, you can see that is what it's anchored on. So we have our buy side imbalance, sell side inefficiency. Okay, yes, we went down, but we left a small portion open, so that means it's always a candidate to come back and revisit that area. And if it overshoots it, that's fine. The order block on the 5-minute chart is always a possibility. Okay, so we traded down into it, completely closed and hit the order block. And then we had consolidation. And then we entered into the 10:30 to 11 o'clock time window. And we dropped down initially right at the 9:30 opening. Where are we at here? 9:30. Right there. So at 9:30, we had sell stops below here. It tagged those, came back up for the buy side, buy stops here. And then notice they left these relative equal highs open. So we left buy side liquidity, that's buy stops, above these relative equal highs. Now, traders are taught that this is resistance. So therefore, lower prices should be expected. And we did. We had lower prices, but down to a level of a discount. And my expectation, much like I was sharing with the ES, there's a daily volume imbalance up here in that shaded area. So I felt that was a draw on liquidity. So that means what? Even though we had a movement lower at 9:30, going into the 10 o'clock hour, it's going down to go up. And because it's FOMC and it's also the non-farm payroll week conditions, now, when I say week, not W-E-A-K, W-E-E-K, the week, Monday through Friday. Because it's non-farm payroll week, that tendency to be sloppy in price delivery. It's not as precise. Targets won't really get filled perfectly or maybe not even get touched at all. When we're looking at a market that's likely to go up, and my belief was we were likely to go up into that volume imbalance, as I mentioned yesterday. That was a potential draw if we continue to go higher. If we see the market drop like this into a deep discount, it's likely to go higher and attack, number one, the buy side here. If it's going to go above here, it might just go all the way up into that daily volume imbalance, which is that shaded area up here. Okay. So with that in mind, let's look at how the market dove into that 1-minute fair value gap in the form of a buy side imbalance, sell side inefficiency. So we trade down into the order block, we trade down into the BISI, buy side imbalance, sell side inefficiency, which is a form of fair value gap. It rallies up, consolidates, and then we dive one more time below short-term low, and then we run above this short-term high here. Okay, so that is what? That's a shift in market structure while it's in discount. Okay, it left this fair value gap right there. Okay, so this fair value gap, let me take it off so that way you can see it. That one candle right here That's your fair value gap. So let's add it back. And the way I did that is click on it, highlight it, hit the delete key. It takes it off. And then when you want it back, just hold down Control and tap Z. Okay, so it'll undo that in case you want to know. And then the market ran away above this fair value gap. And I mentioned that I wanted to see price stay above that, and it would not go back below that. It's not needed to. Okay, and I'll get into that when we're doing the live walkthrough of the trade execution and management. But I want to cover why I chose the Nasdaq today versus the ES. If you look at this, and we're going to add the use of the ES. Okay, so all I did was compare. Now, with a vertical line, everything during with this low, they match. All right, if we drop a vertical line on the chart here, let me thicken that up and darken it up for you. Okay, so this is our reference point. So wherever I drag this, it should have matching highs and matching lows, okay? Now watch what happens when I drag to the right, going forward in time. Okay, right there, we have this high higher than that high. Slightly higher than that high. See that? ES is not showing the strength to the upside that Nasdaq is here. So keep marching forward, going forward, and right there, we can see that this high and this high, Nasdaq is lower, but ES is higher. Doesn't mean anything yet. Watch what happens. We have now this short-term high that's been taken out by this high. This high is this high here for NQ. Okay, so Nasdaq's high is here on the 1 minute chart, and ES's 1 minute chart high is here. Over here, look what we have. We have relative equal highs. See that? But we have a stronger, higher punch through by NQ. So Nasdaq was higher here. After, here's the key point, a short-term high was taken, and then a fair value gap was left. Okay, after digging into this 1 minute buy side and balance sell side efficiency or gap, okay, and we expect the market to turn here. So we have relative strength analysis on our side that NQ or Nasdaq futures was the better buy. And again, why? The short-term high here is much more prominent of a break here than it is here. These are relatively flat. This, I'm looking for the relative strength leader, one that wants to break out higher, faster, stronger, okay? And while they both pretty much moved in sympathy with one another, the more sharper technical picture was seen in the Nasdaq. Notice that there is a small little gap here, very small. Let me zoom in here without messing up any of the relationship between the two. There's a small little gap right there, but look how sloppy it is. See how it completely goes down below it? We don't have that here on Nasdaq. Okay, we don't see that. Why didn't we see it? Because it's stronger on Nasdaq. Nasdaq had much more relative strength comparatively to that of the ES, E-mini S&P. So I'm going to trust this one because visually I can see that fair value gap. It's much more prominent here versus the very lethargic looking fair value gap down here. This one's much more energetic. It's much more obvious. And it is also with a market that's moving more explosive to the upside. Okay, so I want to be in this market buying this fair value gap right there and trusting that it will not completely close in. Why? Because we want this to act as what? A breakaway gap. Why should it be a breakaway gap? Because we've already traded down into this 1 minute fair value gap in the form of a buy side and balance, sell side and efficiency. So the market rallies from here and trades into, I'm going to take this ES off now, okay? So we've accomplished what it is that we needed to have in terms of insight from it. Let's scrub this over. and the market trades down into this fair value gap here, and then leaving this range right there, you'll see that that's drawn, and I talk about how it's not going to go back below that. The algorithm will not reprice back below that. Why? Because this, in this area here, it becomes a balanced price range. One single pass, and we have a fair value gap. So it's going to work in this one and then accumulate new long positions. I even talk about how this area here with this fair value gap, I'm going to draw it again like this. I even stated that you would see this form support. I typed it out and you'll see it again as I did it. And the only thing I was incorrect about, and this is typical of FOMC and also non-farm payroll weeks, where my precision is just a little bit skewed. This low right there, I looked at it as a potential to create an institutional order flow entry drill, which is just a small little movement into a fair value gap that doesn't completely close it in, and you can buy it. High frequency trading algorithms use that as a entry model. Just know that it is a partial entry into a fair value gap that will not even go halfway. Okay, it's just like small little entry into it and then picks up orders and runs. Okay, so that's basically all it is. So it's an entry into a fair value gap, but not even the halfway movement of it. And you see the market does in fact create support here. It rallies. I anchor to this down close candle. It's open price. Draw that out in time. Anticipate a order block forming. Find some support. Creates a small little gap in here. This is a measuring gap. So we had a breakaway gap down here. And this is a measuring gap. So from this long to this point here, that's essentially half of the move. And then we have buy side up here. So we can target the bulk of our exits just above this high here because we have a confirmation that this isn't getting filled in. And you've already seen several examples of me doing this. This is how you determine and classify real time a measuring gap. That idea of gaps or inefficiencies in price where there actually is no trading at all, that's a real liquidity void. Things like this get called a liquidity void. And that's unfortunate because it's not a liquidity void. This is a buy side imbalance, sell side inefficiency. It's buy side imbalance. That means it's moved too aggressively one side to the buy side, and it's inefficiently delivered for sell side. So what is it? Buy side imbalance, sell side inefficiency, which makes it a BISI. I made these names up for that very reason. The algorithm creates these little areas here, and we want to see this type of thing stay open. Okay. So the market continues up. I mentioned that this would be an area where the next draw on liquidity would be, which is a rejection block. And then I mentioned I'd take 3 above here, and I do. And then above here, I took 3 more, and then I left 2 on, wanting to see it trade up into that daily volume imbalance, that shaded area up here. And I took 1 off when I felt that it was not likely to go up there entirely. It almost stopped me out here. And finally, I looked at this as the last line in the sand. If it crosses that, I'm going to let it take my stop. And it gave up the ghost and come out and stop me out. And ever since then, it hadn't done anything higher. Okay. Now I want to go into the actual replay and management of the trade and how I did everything and why I did it when it happened. Okay. And let's do that now. All right, so with everything I've just outlined, all the logic as to why I'm anticipating it, I'm going long here. You can see the actual orders. And don't be discouraged by the 2100. That's actually 2.1% risk. Okay, it's based on a $100,000 paper trading account. So buy side liquidity, that's where my initial draw on the market is. So this is a market maker buy model. So there's the order block. I'm waiting for price to move away from that. I want to see it expand up above these relative equal highs here. That's buy side liquidity. So my eye, it should be, or your eye should be trained over time. And now my stop is to break even. because if it goes back below after running those relative equal highs where the buy side liquidity is written, that would not be a good thing. So I want to make sure I'm controlling risk. So I want to see this fair value gap, that pink area, act as support. Okay, so what specific level? The high of it. I want to see it expand above it. And as it's starting to go up, I'm watching how price is gravitating towards that rejection block. Okay, and I like the expansion that we're seeing here. And I'm not thinking that we're going to collapse and go the other direction based on all the things I've already outlined. And there is a daily volume imbalance that's already shaded on my chart. You can't see it yet, but I'll scrub the video down on the axis, on the price axis, and you'll start seeing it in a moment. But I just moved the stop up, and I'm going to look to buy or pyramid more of this position as it drops back down into that fair value gap. When this candle closes, I'm anticipating a fair value gap to form. There you go. So now I have a gap there. So I like that gap being there above the shaded area that's pink. So I don't believe that that's going to have to be traded back down through. So that pink area becomes an area of a balanced price range. So I'm basically stating that the algorithm is not going to reprice below that, and it's going to be attacking the liquidity at 11,050 buy side. So that's basically above the buy side liquidity pool that's being highlighted in the upper left-hand corner. So I'm moving the stop up. I can trust that the stop will not be hit because the pink area is a protected area. The algorithm does not need to go back down there. And the reasons why is because it's already repriced and it's aggressively going to attack what? Those buy stops above those equal highs at 11,048. So 11,050, that's where I'm anticipating the next draw on liquidity. But there are two targets before we get there, and I'll obviously mention them as we go. Now that right there is a classic bull flag. I don't want to get wrapped up in thinking it's going to break down, but it comes down into this little area in here, back into that fair value gap that I like. Okay, I like that gap that's not being shaded yet. I like that right there. So I'm telling you with this annotation that watch the support form here. Where at? Right at the top of that fair value gap. And I want to pyramid more. So the 6th position contract long I have, and now I'm going to draw out that fair value gap here. I want to be in more of the position. I like the fact that we dug down into it 2 times. We went down into that blue shaded fair value gap twice. So I'm putting 2 in there, whereas I normally would have done like 3 or something to that effect. I just want to make sure I'm building more position. And I'm basically saying that naked charts are superior to indicator driven. Unless you have a time-based chart, you're not going to see these elements. And watch how price shows how it wants to rally. I'm expecting large ranges to just now come in. So in other words, I'm expecting price to begin to start moving higher. As long as we're not digging into that pink shaded area, it can dip down into it, but not by much. And I'll explain that as we go. So I'm looking for the beginning of green candles moving up. Notice also that we went from large green candles and now we're in small little range candles. Okay, so the next expectation would be what? Big candles. So if we're bullish, we don't think that that pink area is going to go and break and allow price to go down, then the next series of big candles should be in what direction? Up. Okay, so when I'm annotating my chart, I'm typing out, large range candles are coming or big green candles are coming. I'm studying, and I just went in and bought more. So my position's at 10 contracts. I'm saying this is the final partial entry, but I want to illustrate further if the opportunity presents itself. So 10 contracts is about as much as I wanted to do with this position because it's a big position. Like I'm looking for like 600 ticks. And it's a pretty significant run in price. I've already highlighted the next buy stop or buy side liquidity right above that 11,018 and a quarter. Now right here, this is again the rejection block. So I'm anticipating price reaching up into that. And watch what the algorithm does here. It's designed to do this very thing here. When bull flags are correct and it's anticipating a higher run in price, it will always likely do this very thing right there. Boom, stops are engaged. So now I'm typing out that it will sharply reverse higher here based on what I'm just explained to you there. While I don't have that pink range on the chart again, just know that it can dip down just a little bit below that bottom of that highest blue rectangle. It can do that just by a little shallow little dip below that, and that's all that would be reasonable. And then higher prices would be delivered. While I do believe that that range that was shaded in pink that I no longer have on the chart because I want to keep your attention on the very salient moments as prices being delivered, I'm thinking to myself, it might offer an institutional order flow entry drill. So it may need to go just a little bit lower, a couple ticks lower. I'm extending the fair value gap. And I'm just, again, reminding you that's where I'm thinking it's going to go. These are all done through TradingView live. There's none of this annotations after the fact. It's all happening real time. And you can see one of the other signatures of why I don't like trading post New York session on Wednesday is because it's like this. Okay, it's not as precise. Like I usually get in on the low candles and get on the high candles, and it's just real muddy during this particular time of the month. And I'm anticipating a likelihood of institutional order flow. So if it trades down and just touches just below that line there, I would go in with another partial and pyramid more and trust the fact that it would not collapse going lower. And got my finger on the trigger to buy one more in the event that it drops down and offers me an institutional order flow entry drill. And all that is me dropping a long if it drops below that little trend line I have there. And I'm highlighting that big up close candle. If it dips down below that, I'm thinking that it's just one last little attempt to trick traders going short before it rips higher. So I'm just sitting there waiting in the event that it offers it to me. I'll take and add one more contract long. Now I'm drawing your attention on the level that was just outside the view of your viewership on this video. That I'm not sure what color that is, to be honest with you. I want to say yellow, but it may not be yellow. So I don't know what that color is. But focus up there, and that's a good distance away. So we're not looking at little tiny micro scalps. And we're looking at the down close candle. It's to the left of where price is now. I like that as an order block. And I just put my limit order up there just at the bottom of that daily volume imbalance. So I just extended it out for a bullish order block. Now, I was actually trying to anchor to the high of that candle, but because I'm, again, monitoring a 1 minute candle, I know the likelihood of it touching the open is there. That's fine, but I would have anchored it if I had cared enough to do it. I would have put it right on the high, and you can see it would have hit it perfectly. This is beautiful delivery now, so I want to see it run up above that 10,987 level. And watch that order block because it can always be reclaimed. Now, a reclaimed order block is where it acts as support, it runs away, and it comes back down and trades into it again. It's completely normal. So I'm looking for a price to want to reach up into that rejection block, which is where I have annotated 2 contracts will come off above the rejection block. So I'm anticipating it's going to spike up in there. And I'm going to get a little overzealous here and type out the very instructions that I'm selling 2 contracts. So it's a sloppy day, and sloppy days are, they're very hard to work with, and I don't like to engage them. We'll be doing some of them where I anticipate this likely very thing happening, so that way you know what it feels like to be in there watching it. Don't turn them off. Okay, you want to know what this feels like and how to engage them. Okay, you all think, all these setups that I show, you're going to walk out there and do the same thing and know exactly how to do it because you watch some videos like ICT Netflix. That doesn't work. Okay, you have to be out here in the trenches doing this. And okay, so I put that shaded area in blue, that little thin one. That's a measuring gap. So I'm looking at it as it might give me an institutional order flow, like just trade just into a little bit. You can see I'm getting ready trying to buy 2 if it gives it to me. But I prefer to leave it open. Okay, and if it leaves it open, that's a measuring gap, then I can trust that we're going to go up to 11,050, 11,060. So 2 contracts have been taken off as a partial. Stop is still where I have it. The first contract I'm going to try to take 3 of them off above that next level of 11,018 and a quarter. But notice what I do. I don't go and click 3 at one time. I want to try to gravitate towards that 11,048 level. There's buy side liquidity. Now there's me taking one off there. I'm watching. I want to see the expansion. There's another one coming off. I want to see if I can get a little bit more movement on this candle, knowing that it's going to go to 11,048. And there's the third one. Okay, so now I have 5 contracts still. And here is the 3 I just peeled off. So now I can begin to consider moving that stop loss up because I've taken 2 partials. And it's now below where I think that is a measuring gap. So there's no need for it to trade back down there. If it does, I want to be out anyway. So I've locked in 37.95 on the balance of the trade with the expectation that we're going to gravitate towards this area here, which I'm going to make more prominent so you can understand that I'm going to take 3 contracts above this level. So you know what I'm going to be doing before I do it. I have 5 contracts still. And I'm going to do the same thing I just did, okay, which is running down equity. That's the principle. That's what I named it. The principle is that when we dig into pools of liquidity, we don't just indiscriminate like you've seen me do in other examples. That's the easy way because I'm recording something and I'm busy. I'm doing other things. I was doing mentorship lessons and I still wanted to share examples. What you're seeing here is exactly how I trade. I'm peeling them off as the candlesticks are forming and expanding more and more and more. I'm not just dumping all of the, if I want to take 3 off, I'm not just doing, okay, let me just take 3 off immediately. I'm going to try to squeeze as much juice as a lemon as I can. And sometimes it's really nice. And other times it doesn't allow me to get all of them off. It will come back in reverse and I have to either exit the trade or maybe even retrace more and allows me to add more. I'm not wanting to add anything here, but reminding you all here as viewers that there's actual buy stops resting above those relative equal highs, and they're going to be targeted by the algorithm. And I'm reminding you all that 3 contracts will be peeled off the same way I just did it when we went above 11,018 and a quarter. So everything's going as planned, again, using TradingView, real time. You can't do this with market replay. You can't fake this. It's all, I'm letting you see everything. You're seeing all the order numbers. Everything's popping up as you would expect it. So I'm taking off 1, 2 contracts, 1 more contract when we expand above the high. I want to see it make a big, bold move above the candle's high right there. See how it's doing that? Now I'm running down equity. Every time we make a new high, I'm peeling 1 off. So now I have 2 contracts and I want to see if we can get up into that volume imbalance, that shaded yellow orangish area where I have typed out focus all the way up here, daily volume imbalance. Now think about where it's trading at right now. If I fail here and it comes all the way down and takes my stop loss from this point here, I don't care. I don't care because I've taken the lion's portion of the move I've been very precise about where I've entered with logic. I've taken logical levels of partial profits along the way where smart money would engage because this is where the liquidity is. So I'm going to be looking for a run up into this area here. So I mentioned here, I don't care if I get stopped out. And now I'm moving a stop up aggressively. So again, the point is I've already took the portion of the trade-off that would be, in my opinion, the bulk. So it came real close to my stop loss. And when Forex, that would have stopped me out. That's the difference in the markets. These are a lot more forgiving and more precise than Forex. So for an FOMC day, I call this satisfactory. All right, so in summary, this trade was a paper trade. And there is the account history. So from 100 all the way up to finally at $121,185. So 21.1% return, one trade. And there's the business. So you can see it's all real, all executions done just like you saw me record them.